Hey everybody, my name is Paul Vojchehoske and welcome to the Real Estate Classroom YouTube channel. Just a place that if you're trying to pass your real estate exam, you can get videos that'll help you do that. So in today's video, we're going to discuss a transaction, a real estate transaction called a short sale. It's a type of transaction that we've seen a lot of back in 2009, 10, 11, and 12 during the real estate crash. We really don't see them anymore in today's market because now we are on the opposite end of what was going on back then, and that is we're in a housing shortage. So we're on the opposite side of the circle, but there's always a chance it will come back around. We're not going to get too much into detail as far as what they are. I just want you to know the basics, the 50,000 foot view, and know enough to not only be familiar with it, but also to pass your real estate exam. All right, so what is a short sale transaction? Well, I got a definition on the screen. It says a short sale occurs when the property owner or the borrower does not have enough equity to cover the balance of the mortgage and release the lien from the property. Therefore, the owner requests that the lender accept a lesser amount that's owed and at the same time release the lien against the property so the property can be sold to another buyer and that buyer can receive free, clear, marketable title. So let me give you an example, a common example that we would see back in the 2010 timeframe. Let's say in 2007, the property owner purchased the property for $200,000. 2010, the market imploded. The value of that property is now $150,000. The amount that's still owed on the property is $195,000. In the meantime, because the market crashed and the economy is blowing up, that person maybe lost their job or they were demoted to part-time. They can no longer make this house payment, so the logical thing is to sell the property. The problem is the house is only valued at $150,000, so that's all they're going to get for the property, but they owe $190,000. So how was that reconciled? Well, what was happening is in the early onset of the market crash is the owners were just abandoning the property. And, lenders are going, listen, we don't want vacant properties on our inventory because we're not in the real estate business, we're in the lending business. And for a lender to absorb all of those properties, those vacant properties, that's a huge, enormous extra cost. So the idea of a short sale really took hold. So what it allowed this borrower, this owner to do is to go to the lender and say, listen, I owe $190,000, the market value is $150,000. I want a short sale. So I'm going to sell the property and we're going to sell it at that $150,000 market value. I want you to forgive or forego that $40,000 that we are upside down and release the lien so the buyer of the property can get free, clear, marketable title. That is essentially what a short sale is. It is asking the lender to agree to a lesser amount of debt that's owed and at the same time release the property free and clear so the new buyer can have free, clear, marketable title. This benefits the borrower and the lender at the same time. For the lender, they have two options, either agree to the short sale or what's going to happen is that owner's just going to abandon the property. Then that lender has a vacant property. It's subject to vandalism and theft and everything else. This way, it allows the owner to stay in the property, live there until the property is sold to somebody else. The lender is not having to get it winterized and all of that. At the same time, it benefits the borrower because the borrower gets to stay there and they get to get out from underneath that home loan penalty-free many times. We're going to talk about the penalties a little bit later in this video. So it was actually a win-win, a benefit for both the lender and the borrower. All right. So, and the biggest thing is it avoided foreclosure as well. Foreclosure processes are very expensive, and in some states it would take 2 or 3 years for a foreclosure to happen. So that property literally could stay vacant for 3 years before a foreclosure happened. In the meantime, what happens to property when it's vacant. So foreclosures are the last. It is the last. That's what we do when we're desperate. Okay, so short sales was very beneficial to both parties. Now, short sales. What if we have, now remember, we said that a short sale is a request for the lender to accept a lower amount and release the lien. Now, one of the things that would commonly happen back then was there would be more than one lien against the property. There could be a first mortgage. There could be a second mortgage or a HELOC. There could be a mechanics liens or child support liens or IRS liens. Those were common. So the listing agent had to navigate all of those different liens because all of those liens had to be waived and removed for the short sale to move forward. So what would happen is the listing agent would put the property up for sale at $150,000 using our example, contingent upon a short sale approval from the lender. Then the agent would work with the lender or the lenders to negotiate a win-win. So they get an offer for $150,000. They would go to the first mortgage company, the mortgage company that's in first place, and say, as it looks right now, you're going to eat basically $40,000. Do you agree to that? Once the lender agreed, then they could move forward with the sale and go on to closing. But when there were more than one liens, what would happen is the listing agent did a lot of negotiating, because not only do you have to negotiate with the first lender to get them to release the lien, then you have to go to the second lender and get them to release the lien. Then you have to go to the mechanics lien holder and negotiate something there. Maybe there's child support. You had to go to the state and get it waived. And they were very complicated, and a lot of times they took a long time to get closed. Ultimately, in the end, sometimes what would happen is it was just impossible to get all the parties to agree. I was involved in one transaction where the first and the second lender, the first lender said, yes, I'll short it, I'm fine. The second lender said, we will remove the lien, and they got zero because they knew they were going to get $0 back. However, the IRS would not release a federal income tax lien. And so ultimately what ended up happening is that property did have to go into foreclosure because the IRS refused to remove the lien. I had another case where there were two lenders involved. The first lender released the lien, and they got, I think if I remember correctly, it was like a $250,000 transaction, and it was like $300,000 was owed. So there was a $50,000 short. But there was a first and a second. So the first mortgage company basically got all their money back, but the second mortgage company, there was no equity. They lost everything, but both released the lien. But there was a mechanics lien against the property for work that had been done and not paid. And we had to go in and negotiate, and the mechanics lien holder basically decided he would take 15% on the 15 cents for every dollar that was owed, but we were able to negotiate it, and it did go to closing. So these are the things in a short sale that a real estate listing agent has to deal with. On the other side of it, the buyer and the buyer's agent, they're at the mercy of all these parties making a decision. There were times when it would take 6, 8, 10 months for a deal to close. And as a buyer's agent, they had to counsel their buyers appropriately. And then ultimately, sometimes the best thing for the client was to simply file bankruptcy and walk away from it. That did happen at times as well. So short sales were, well, I'll tell you one thing. If you were a real estate agent back then and you were doing short sales, which just about every transaction was, you earned your pay. There was no doubt about it. The next thing you have to know as a real estate professional about short sales is a lot of times the lender, when part of their approval process, remember, the borrower is asking the lender to accept a lesser amount that's owed and release the lien against the property. So what would happen is real estate agents would sign a listing contract with that seller for a 7% commission, 7% of the purchase price. But the lenders in the end almost always would dictate what that commission was going to be. So the lender would come back and say, we will accept this short sale. However, we're only going to allow a 4% commission or a 5% commission, 5% of the sale price. And that's just the way that it went down. So the lender does have the discretion to dictate what the commission rate was, and they commonly did that back in that time frame. Now, there are some ramifications to the borrower that you have to know. Number one, they didn't get away with this scot-free in that their credit history took a hit. It wasn't as bad as a foreclosure, but it's still reported on the credit report as a short sale. The biggest difference between a foreclosure and a short sale is the time period before you qualify again to buy another house. So during that time, 2009, 10, or 11, if somebody had a short sale transaction, it was reported onto their credit report, but literally within 3 or 4 years, they could get another mortgage just like that. Unlike a foreclosure, where it could be 6 or 7 to 10 years. So in that aspect, it was a ramification in the negative, but it was positive in that it wasn't as bad as a foreclosure. Now, the other thing that happens for short sales is what's called a default judgment against the borrower. So in our scenario where the property's worth $100,000, but or $150,000, but they owe $190, and the bank said, okay, we'll give the short sale. Well, that bank lost $40,000 on that transaction. The bank does have the right to place a default judgment against that borrower. It's a lien against the borrower, and they can garnish wages and things like that for that debt that's owed. Back in the day, in 2010, 11, and that, most lenders didn't do that. There were some that did. Point is there's always the option for the lender to do that, place a default judgment against that borrower. And then the last thing is a tax penalty. The IRS and every state that has income taxes considers the forgiveness of debt as a taxable event. So here's a common thing that happened. In our scenario, the bank was going to basically release this lien for $40,000 less, basically $40,000 less. So one option, so essentially the lender has two options. They can go down the route of a default judgment and try to recover that money from that borrower, which is expensive and you have to file lawsuits and whatnot. Or they could just forgive the debt. And that's what almost all of them did. They would just simply forgive the debt. Now, forgiveness of debt is a taxable event, and the IRS wants their money, and that means that the borrower owed taxes, income tax, federal and state, and local if they lived in a local jurisdiction that has income tax. And so they had to pay the full Social Security tax, the Medicare tax, the income tax. So $40,000, that person may owe $10,000 or $15,000 in taxes on that event alone. Now, during that time period, Congress had passed some legislation that basically waived that tax penalty, but that has long since been expired. So in today's world, if you do a short sale transaction, one of the things you have to do as a listing agent is counsel your client, your seller, that, hey, there's a tax event that's going to happen if the bank's going to forgive the debt. So you need to talk with a certified public accountant or a tax attorney to find out what that penalty and ramification is. So, all right, that's it for this video. Hey, if you're going to continue studying, check out this video right here. It will help you. And if you have not subscribed to the channel, please do so. Click the little circle to my left here and subscribe to the channel. I would appreciate it. I'll see you all in the next video.